Rip-Off Britain viewers seriously worried about their future. This is someone who knows her stuff when it comes to money. Dr. Gaia Garino is a university lecturer in economics. So when she needed a £48,000 loan for medical treatment, she was confident that securing it against her home was the best way forward.
I have a good job, there was equity in my property, and I needed this money because I had incurred previous serious expenses, so I was absolutely fine with it.
She'd seen adverts for a company called First Plus featuring Carol Vorderman and thought they seemed a good company to go with.
You could borrow anything from £5,000 to £100,000 at a competitive rate like this.
Before signing on the dotted line, Dr. Garino did her research to make sure a variable rate loan was right for her needs.
I did read the terms and conditions before signing them, of course, and I made sure I understood and appreciated that the interest rate would be variable, but what I did understand was that it would go up and down.
That was in 2006, and over the next 14 months, the loan's interest rate went up 5 times. But as this was just prior to the crash of 2008, and therefore a period of instability for the banks, those rises didn't worry Dr. Garino too much.
I was fine with this because you would expect any bank to move in line, and those times were times of high interest rates.
So when the bank base rate fell to an all-time low, Dr. Garino looked forward to seeing her rate do the same. Being an academic, she's been able to work out what actually happened and put it into a handy presentation just for Rip-Off Britain.
So this is my First Plus interest rate starting at 9.4 in October 2006 when I took
the yellow line at the top is the interest rate Dr. Garino was paying. The dark line is the Bank of England base rate. You can see that while the dark one goes down sharply, her own rate at the top does nothing of the kind.
Then we come to 2008 when the base rate plummets and my interest rate here stays the same.
With her First Plus interest rate remaining high, Dr. Garino is now baffled about how variable rate loans actually work.
Second charge loans should really work like a mortgage, like advertised by First Plus, so the rate should really go up and down like a tracker. I accept the interest rate should be higher because there's more risk for the lender, but other than that, it should go up and down, not only up.
And surely this is what the word variable means. The Oxford English Dictionary defines it as not consistent or having a fixed pattern, liable to vary or change, assumed to vary. That doesn't seem to suggest the change should be just in one upwards direction. But financial services specialist Adam Samuel says that when it comes to interest rates on loans, variable doesn't mean quite what you think it does.
It's not at all surprising that people are confused, partly because the word variable rate doesn't mean anything. It just means we, the lender, can choose the rate of interest we're going to charge you on the loan you've taken out with us.
First Plus chose to set their rates up to 10 times higher than the base rate. So when lenders do that, are they being greedy, or is it because in tough times they've got problems of their own?
They've got big levels of loan delinquency. That's lots of people not making their loan payments on time or at all. They've got big payment protection insurance mis-selling compensation to pay, and they have no great incentive to bring the loan rate down, and every incentive to try and make some money from keeping their rate reasonably high.
First Plus says that changes to customers' interest rates were made in a completely transparent way and only took place where pricing needed to reflect a change in costs. Dr. Garino knows First Plus are within their rights to apply the clause in the terms and conditions which says that the rate can go up as well as down, but it's left her and many other customers with real fears for their financial future.
The lender can apply the clause in a one-sided way, so I'm very concerned because it means that we are basically there to be, milked for as much cash as we can give out in order to keep the business afloat.
The experience of Dr. Garino and everyone else in the same boat shows what a minefield taking out a loan can be. So if that's something you've ever considered, here's personal finance expert Ed Bauscher with some advice on what to watch out for.
If you're thinking of taking out a secured loan, please consider the alternatives first. You can transfer your debt to a 0% credit card and then pay off your debt without paying any interest at all. Another option is to remortgage or do a top-up to your current mortgage, and then you'll probably be paying a lower interest rate than a secured loan. The alternatives to secured loans all have their pluses, but sadly not everyone will be able to get one of those alternatives. If you're going to take out a secured loan, first thing to do is make sure you're going with a reputable lender. I think do an internet search and just check they don't have a history of dodgy lending. Think about the length of the loan. If the loan is over a long period, say 10 years, your monthly repayments will be relatively low, and that's attractive. But of course, over a longer period, you'll end up paying more interest. You may also be offered a cashback loan. Now, that means that when you come to the end of your secured loan, you may get some of the interest you've paid back. Now, that sounds great in theory, but there are normally lots of catches to a cashback deal. If you miss one monthly repayment or you try and pay the loan off early, the cashback will end. So I think you're much better off just going for a straight, simple loan and not for a cashback special deal.
We're back at our Rip Off Britain pop-up consumer advice shop, and it's a first for the series.